Welcome to Earnings Recap. Today we're covering Coinbase's first quarter 2025 earnings report and call.
That's right.
And, beyond just the numbers, a big piece of news. Coinbase just secured a vital registration in India.
Yeah, that's pretty huge.
Think about that. It sort of opens a direct path to potentially 1 billion new crypto users. It's massive.
Definitely a long-term play to watch.
So our job today, really, is to dig into this earnings report, the call. Break it down for you in plain English.
Yeah, highlight what's important, why it matters.
Exactly. So you understand what's really going on and why these details, should be on your radar.
Okay, let's dive in then. The big headline number. Overall trading volume, it jumped 26% year over year, $393 billion.
It's pretty good on the surface, right? 26% up.
It does, but when you start peeling back the layers, it gets a bit more complicated.
Right, because if you break it down, consumer trading volume was actually down 17%, fell to $78 billion.
Yeah, and it wasn't just the everyday traders. Institutional volume, the big players, that was also down 9%, $315 billion there.
So wait, overall volume is up, but both consumer and institutional are down individually. How does that work?
Well, that's the key, isn't it? This difference tells you something else must be driving that overall increase.
Okay.
It suggests, maybe a different type of trading activity is picking up steam, or perhaps the mix is changing quite a bit.
And that comes into sharper focus when we look at the actual revenue from those trades, doesn't it?
Exactly, because the revenue drops were even steeper than the volume drops.
Yeah, consumer transaction revenue fell 19%. And institutional, that dropped a lot more, 30%.
30%, that's significant.
So it's not just fewer trades in those areas. It seems like they're making less money per trade as well. Why would that be?
Precisely. The revenue per trade is shrinking in those core segments. It hints at maybe different assets being traded, or like you said, maybe fee structures are changing. We'll definitely need to dig into why that revenue decline outpaced the volume one later.
Okay. But it wasn't all negative news. The subscription and services side actually looked pretty strong.
Absolutely. That segment grew 9%. Hit an all-time high, actually. $698 million.
That's a definite positive.
Wait.
Shows diversification.
It really does. It highlights they're successfully building income streams beyond just those volatile trading fees. This kind of recurring revenue offers more stability.
Especially in the crypto market, yeah.
For sure. So the key questions are, what's really driving that growth? And, how sustainable is it?
We'll get to those drivers. But first, the bottom line number, net income, reported at $66 million.
Okay, still a profit.
Still a profit, yes. But compare that to the same time last year, $1.176 billion. That's a massive drop, over $1 billion difference.
Wow, yeah, that's a huge swing.
What on earth caused such a dramatic fall?
Well, it really underscores the impact of some of those factors we've touched on, the revenue pressures, and probably other costs or maybe market events squeezing profitability too.
Right. Understanding the billion-dollar swing is pretty crucial.
Definitely. And then there's adjusted EBITDA. That decreased too, but less dramatically. Down 8% to $930 million.
Okay, adjusted EBITDA. For listeners who might find that term a bit jargony, how does that give us a clearer picture than net income?
Good question. Think of adjusted EBITDA as trying to show the core earning power of the business itself. It strips out things like interest payments, taxes, depreciation, which is like accounting for wear and tear on assets, and amortization.
Stuff that isn't direct cash flow from operations.
Exactly. Non-cash stuff, financing costs. So it aims to give a clearer view of the cash being generated by the main business activities. The smaller drop there suggests the underlying operations are still pretty profitable before those other accounting items hit.
Okay, got it. So we have the main numbers. Now let's really get behind them. Let's start with that institutional revenue puzzle. Volume down 9%, revenue down 30%. What was going on there?
Right, that discrepancy. It really comes down to two main things, two deliberate strategic choices by Coinbase, actually.
Oh, interesting. So it wasn't just market forces.
Not entirely. First, they're pushing hard into derivatives trading, building out that platform.
Oh, yeah.
And to attract users, to build liquidity, basically make it easy to trade. They're offering rebates and incentives.
Paying people to trade, essentially.
In a way, yes. And in accounting, those rebates are treated as contra revenue. They directly reduce the reported transaction revenue.
So it looks like less revenue, but it's actually an investment cost.
Exactly. It's a calculated investment to build that derivatives market for the future. It's a potentially high growth area for them.
Okay, that makes sense. Investing now for later gains. What was the second factor?
The second factor is about who is doing the institutional trading. There's been a shift.
A shift in the mix.
Yeah. More volume is coming from market makers and liquidity providers.
And they get better rates.
Much better rates.
Mm.
They operate on really thin margins, so they pay significantly lower fees than, say, a hedge fund might. So even if their volume is high, the revenue Coinbase actually gets from each of their trades is lower.
Right. So more low-fee volume pulling the average revenue down.
Got it.
So strategic investment in derivatives plus a changing trader mix explains that gap. Okay, let's flip to the good news again. That 9% growth in subscription and services. What's fueling that?
Well, it ties back to their strategy of building more predictable income, moving beyond just trading. A huge piece of this is stablecoin revenue, mostly USDC.
Okay, how are they making money from USDC?
It comes from higher average balances. More corporate clients and more retail customers are just holding more USDC in their Coinbase accounts, in products where Coinbase can earn revenue on those balances.
Ah, so just the act of holding USDC on the platform generates income for them.
In certain eligible products, yes. More people, more businesses keeping more USDC there, that's a big driver.
Interesting. What else is boosting that segment?
Another significant piece is blockchain rewards, staking.
Right, earning rewards for helping secure networks.
Exactly. And that revenue is up for two reasons. One, the prices of assets like Solana and Ethereum have generally been higher. And two, the actual reward rates for staking some of these assets on Coinbase have also increased. So, higher asset values plus higher reward rates equals more revenue for Coinbase from staking services.
Makes sense. And what about their own subscription, Coinbase One?
That's contributing too. They're seeing growth in Coinbase One subscriptions. It indicates more users are seeing value in the premium features, willing to pay that recurring fee.
So building loyalty there.
Seems like it. It all points to that diversification strategy working, building revenue streams beyond just the ups and downs of trading volume.
Okay, so that strategy seems to be paying off. Now, let's talk costs.
Yeah.
Where's the money going? What about expenses?
Always important. Transaction expenses were up. That makes sense, partly because overall volume was higher, even with the mix changes.
Right, more activity, more costs.
And also, crucially, because of those rebates and commissions we just talked about, the ones for institutional liquidity providers, especially in derivatives, those are direct costs tied to facilitating trades and incentivizing growth areas.
Okay, that follows. What about R&D? Tech spending?
Technology and development expenses were actually pretty flat, relatively stable. Interestingly, lower stock-based compensation costs kind of offset higher spending on personnel costs and infrastructure, keeping the platform running smoothly.
So managing costs there while still presumably investing in the tech.
Seems that way. They're holding the line there to some extent.
And marketing. Sales and marketing saw a big jump you mentioned. What was the push there?
Yeah, S&M spending definitely increased significantly. Two main things driving that. Higher spending on digital advertising.
Trying to get new users while the market's active.
Likely capitalizing on market conditions, yeah.
Yeah.
Attracting new customers. And the other big piece was increased USDC rewards payouts.
Incentives again. Encouraging people to hold and use USDC.
Exactly. Incentives to grow that whole USDC ecosystem on their platform. So it looks like a pretty conscious investment in user growth and USDC adoption. Watching the return on that spend will be key going forward.
Definitely. And lastly, G&A general and administrative.
Yeah.
Also up.
Also up, yes. Mostly due to higher personnel-related costs, probably hiring more people as they grow, and also higher professional fees. Think legal, compliance, that kind of thing. Navigating the regulatory environment isn't cheap.
No doubt. Okay, so summing up expenses. Strategic investments in marketing, especially around USDC, managing T&D costs, but seeing rises in transaction costs due to incentives, and general overhead going up with growth and complexity.
That's a good summary.
All right, let's shift gears from the pure financials. What about the non-financial stuff? The strategy, the tone from the call, international expansion seem big.
Absolutely huge. Getting registered in Argentina is good,
Yeah.
but getting registered with India's Financial Intelligence Unit, the FIU, that's massive.
Yeah, you mentioned India earlier. Huge potential market.
Enormous potential. It's a really significant strategic move for their long-term global plans. Shows they're serious about pushing beyond their traditional market.
And they seem to be looking beyond just trading too, right? This
Yeah.
business account idea with stablecoin payments.
Yes. That's really interesting. Developing a business account specifically for B2B payments using stablecoins. pay-ins, payouts.
Moving crypto into everyday business use.
That's the goal, trying to
Okay.
build that utility beyond just speculation or trading. They're launching a pilot program in Q2, so we'll see how much traction it gets. But if it works, that could open up totally new revenue avenues and really drive stablecoin adoption for commerce.
Definitely one to watch. Okay, capital allocation. How are they managing their cash, stock buybacks, that sort of thing?
Management seems focused on being pretty efficient here. They announced an acquisition using $700 million in cash. Importantly, cash, not stock.
So, avoiding diluting existing shareholders.
Exactly. And they also used $100 million to handle taxes related to employee stock units, RSUs, again, to limit dilution. The share buyback program is still there, but they described it as an opportunistic tool.
Not necessarily buying aggressively right now.
Seems like it. And they still hold a significant chunk of crypto themselves. Their investment portfolio is valued at $1.3 billion, about a quarter of their net cash.
Shows continued conviction in the space.
It does. Overall, it paints a picture of disciplined capital management, which investors usually like to see.
And what about the overall message from the CEO, Brian Armstrong? What was the tone, the strategy he laid out?
Armstrong sounded confident. He laid out this really ambitious long-term vision. Coinbase aims to be the top global financial services app, period. Built on crypto, built on chain.
Wow, okay. Not just a crypto exchange.
Not just an exchange. He actually welcomed new players entering the space, especially as regulations become clearer, but he was quick to point out Coinbase's advantages.
Which are?
Their 100% crypto focus, unlike some traditional finance firms dipping a toe in, and the infrastructure they've built, which he argued is very difficult and costly to replicate.
Makes sense.
Right now, the focus is trading and payments, but the future vision includes bringing traditional assets, like stocks or bonds, onto the blockchain. The tone was confident, long-term focused, seeing regulation as ultimately a positive catalyst.
Interesting. Okay, finally, what were the analysts grilling them about on the call? Any key concerns raised?
Yeah, analysts definitely poked around potential risks. One big one was Circle, the USDC issuer. There's been chatter about a potential change of control there.
Right. What happens to USDC if Circle gets bought?
Coinbase basically said their contract with Circle would survive an acquisition. That seemed to calm nerves a bit.
Okay. What else?
Competition, inevitably. Lots of questions there. Coinbase kept coming back to their crypto-native focus and their infrastructure advantage.
The moat they've built.
Essentially, yeah. And there was discussion around derivatives, again, emphasizing their strategy of attracting pro traders by being a trusted, reliable place to trade those instruments.
So analysts are focused on stablecoin stability and the competitive landscape. Key things for investors to keep watching.
Absolutely. Those seem to be the main pressure points they're monitoring.
Okay, so let's try to wrap this up. To recap, Q1 saw some headwinds for Coinbase in trading volumes and the revenue from those trades, especially consumer and institutional spot trading.
Right, though overall volume was up due to other activity.
But the big positive was the subscription and services side. Strong growth there, hitting a record high, really powered by USDC holdings and staking rewards.
Yeah, that diversification strategy is clearly showing results.
And strategically, they're making big moves internationally, especially with that India registration. Plus, they're pushing into stablecoin utility for business payments.
Key long-term initiatives there. And management seems focused on careful capital use, managing dilution, and they view regulatory clarity, interestingly, as a net positive for the industry and for them.
So here's a final thought to leave you with. Coinbase is making these big bets, investing heavily in derivatives, building out this on-chain infrastructure, pushing global expansion. How do you think the evolving regulatory picture, which is still pretty uncertain in places, might ultimately speed up or maybe even slow down their really ambitious goal of becoming that top global financial services app?
That's the million-dollar question, isn't it? It's such a fast-moving space. Technology, regulation, market adoption, how those three things interact is going to be absolutely crucial for Coinbase's future. Definitely something to keep a close eye on.